Welcome to the case study of the trader which we'll call Russ for the case of the study. This is part 3 of the series. Before the break, we had part 1, which went over the strategy of Russ in detail as far as what indications were, what things he didn't do, so that you could replicate the trades if you wanted. But we had a short break, and no, we didn't do part 2 during the break. Part 2 hasn't been written yet, and in the heritage of the college, when the instructors are starting up something, we go out of sequence. So we go from part 1, and now we're doing part 3. This part of the course is all about the documentation of the trades. Okay. So how Russ does his documentation is he needs to run off a actionable trade plan. That's to get as much consistency as possible between your different trades as time evolves. Then we also show how he enters, and when he enters the trades, what documentation he does, when he exits the trades, what documentation he does, and then how he does the additional documentation for the later review, how he does his trade grade, and then uh, his trade review for this particular time and the results of it. So this is his actual trade plan as shown right over here. And a lot of this is just repeats from last time. He needs a liquid and trustworthy stock where it's within the top 100 as far as the dollar volume for the stock. There's no frequent gaps. It's not an inverse or leveraged ETF or any type of leveraged asset. It doesn't have any wild swings day to day, intraday, since he's a swing trader and he doesn't want to have these surprises between as far as a big change in price in the overnight session, which can go far beyond his stop loss. And then the stock also must be in an uptrend. That's a fairly common characteristic where it's the previous day's close is above the 50 MA, and then you also have a particular slope to it. And then there's a lot of stuff dealing with how different indicators have to have a certain relationship when entering the trade compared to the area of interest. He uses the full area of interest, so he sets the entry line at the upper line, the stop loss at the lower line, does not use any wiggle room at all or jumping the gun just before the area of interest. He's setting a single target at 1.1 return to risk ratio. We went over why in the previous section. It's a little bit over 1, so even if it's a 50-50 is a very slight gain. He then sets the share size to be the maximum number of shares that's possible and still be below the $200 stop loss based upon the risk areas. And then also in his trade plan, he has, after the trades are placed, he records his setup in his not only spreadsheet but also his Word document, and we'll be going over that very soon. So this is the details of the documentations of the trades. The action plan is an important part of the documentation of the trades, but it's set in stone at the beginning and it stays the same until the next review period. These are the things which are between the review period as far as recording what's done, etc. I broke it down into 3 major portions: what is done on a daily basis, and then the prep for review. The prep review is a little bit looser as far as the scheduling of it. Normally, it's updated on a day-by-day basis, uh, but it can slip a little bit here and there. Just want to avoid having this one huge mammoth amount of work just before the review. But if it needs a little bit of touch-up, it can be. And then the trade grade, which is done after the full set of trades is done, and is part of the review. But before going that over that, there's one thing I've seen which is a little bit bothersome, and that is having two moving averages which are fairly close together, and then doing something like, does the MA 150 have to be higher than the MA 200? What does that really mean? So down here, I'm just pretending that we have 200 days in a year, 200 trading days within a year to make things simple. So if you look at it from a SMA standpoint, a simple moving average instead of exponential, just to make the calculations a little bit more obvious and straightforward. The 200 MA is a equally weighted average across the entire year. The 150 MA is a evenly weighted average over 9 months of the year. The only difference between the 150 and the 200 is whether or not you include these 3 months. So what this restriction is actually doing is it's saying is that the average price during these 3 months is lower than the average over the next 9 months. So you go back close to a year, take a little section out of that, and they say, okay, that has to be lower than what the average is for the year. It's not really telling you that much, and just want to get that little nit. So let's get back into the documentation of the trades. On a daily routine, I took one day out of the daily routine for this trader Russ, and you have the date, you go through all your positions, and if the trade is closed, you take a screenshot of what the trade was at that time. When you log back in the once per day, whether it closed between, like let's say you logged in at lunchtime. If it closed after lunchtime the previous day and before lunchtime today, it's going to be the same shot. Also, that when you log in, whenever you enter the trade in, you go through you put in your orders, and after you put in, and you go through, have a text block that lists all the parameters for the trade, and then you put in your orders based upon this list of parameters. This helps a lot during the trade review, because if you made some sort of mistake, you can see whether it was fumbling some numbers, putting one set of numbers where another should be, or that type of stuff. And it's helped a lot by listing all the parameters that you're doing. So after you've entered the trades that close for the day, then going through the list of symbols that you have for any trades that you're going to open, and open those trades. After that is done, you then go over to your Excel. He then goes over to his Excel spreadsheet and fills out the rows appropriate for there. So for that, it was GDX had closed. So what you do is you fill in the port. What this is this is the theoretical position, taking your area of interest high, your area of interest low. From that, you can calculate your risks. Then using Excel formulas, it tells you what the maximum number of shares that you include for that given loss. You can't have fractional shares, so you round down. And it also calculates the return to risk ratio for you as you go along. So this return to risk ratio can be used over here. So for this particular case, it's only needed when you open the trade. Oh, sorry, that's the wrong file. Let me go back over there. The file we want is actually this one here. Okay, so when you open the trade, you can fill out the entire row. So when you open the trade for Moderna, you have the area of interest high, the area of interest low. This will tell you how many shares to use, and then this risk to return ratio tells you where your second target should be, or your only target. You can't really call a stop loss a target because it's not your goal, even though you hit there quite frequently. So one other thing I put in is position cost. So the reason for the position cost is to get a feel for how many positions you can have open, make sure you're not exceeding your buying power, and also after I enter the trade and before I say send, my platform comes up with a, you know, do you want to do this trade, this verification box, and what it does is it gives what the position cost is. And basically, I just make sure that that position, that it's long and not short, and also that position cost is at most like 8K, unless the position cost like here happen to come out to be substantially higher than that. And what that does is if I fumbled something like the number of shares, my entry, my something like that, that is my maximum risk on the trade. As long as I'm long, that's my maximum risk. And what that does is it helps protect you against having a rather severe fumbled loss type thing. You know, if you accidentally pick the wrong symbol or you have the wrong number of shares or whatever, as long as that you're long and that position cost is in the 8K region, 8K is the most that you can lose. And that's a safety precaution I had. Okay. So you've been going along doing this for a couple of months, and I have learned to do this on a somewhat daily basis. What I do is just copy and paste over the screenshots from my daily routine file. When I open position, I copy and paste over the opening of it. When I close the position, and then I do one per page, one open position per page. Then when the position closes, I go back and I copy and paste in the closed position. And then sometime later, I'll show on a weekly chart what happened to the stock for 1 month after I had gone into the position. The reason for this is to see whether or not we have any substantial runners, what would have happened if I had stayed in a little bit longer, that type of stuff. And also, these are on the daily time frame and this is on a weekly time frame. So if there's some long-term trend, like a very long-term downtrend, and that affects how this trades, I can look at it during the review cycle and have that there as an asset within the review cycle. So let's get into the review portion of the trades. So this was filled out on a day-by-day basis. I then go back and look at the actual trades. Let's just go that far. So this was what it should have been based upon all my rules and my area of interest. And these are the actual transactions that were done. I go through the transaction history and I go through symbols by symbol. I go through transaction by transaction, my transaction history. Look at the entry price, the stop price, the limit for the target that was set, the limit for the stop market that was set, the size of the shares. What's important is this section and this section here should match. And if it doesn't match, that's a violation of your trade plan. As a quick check, I put out what the max loss is here, sort of to get a little bit of a feeling as far as what type of slippage issues I have. And then also, it is a glaring red thumb as far as if I made a mistake in my stop loss or share size, it pops up way above 200. And then let's go on to the trade grade section. So then this is my trade grade. I fill out my trade grade during my review section because I have a spreadsheet of what the actuals are versus what the expected was. So I go back and I verify I didn't go off course as far as what the stock is, what my entry price is, etc. One thing I also do is if I have an area of interest that I'm not sure if it's an area of interest or not, I use the zigzag tool of a preset set of values to sort of nudge me back on track. And if it doesn't match the zigzag tool, I'm not supposed to trade, although I did actually trade here, as you can see, for number 6 below. Stop loss, entry, record things, all that type of stuff. So 1 means that everything went as planned. I followed my rules. My entries were proper. My exits executed okay. There was no mistake in the actual process. And then anything that's higher than 1, it turns out I put them as a footnote. Like for 2 here, I had done a whole bunch of 2 errors because my spreadsheet was originally set up for a 1-to-1 reward to risk ratio instead of a 1.1 to 1. And then like for here, I had mistyped in the price on the entry. That was a entry price. So I got filled. This is a couple of pennies outside the area of interest, but that's still a violation. And then this one here is the position size, stop loss less than 200 is probably one of the most important columns here. And my violations were basically because I hadn't done my share size properly. But you'll notice that the share size, although it's off, isn't off by too much. I mean, it didn't add another 0 or something like that. Because if I had done something like that, it was shown up as far as my total expected position size. And I would cancel the trade before entering it and go back and re-enter the order in the platform before hitting send. Okay. Now, one other thing that is done is looking at, the what ifs. I made up some fictitious parameters here. You know, in addition to my profit and loss, would I have done better if I had used this RSI ratio or MACD ratio or CCI ratio? So you can go back and then you can filter. This is the actual trade results, which was 13 winning trades, 13 losing trades. Since my risk to return ratio was a little bit higher than a 1-to-1, I actually had a profit of about 2 times my risk. Some of these profits are above 200 because I'd entered when I log in the once per day, I'm already within the area of interest. I still size it as if my entry was at the top of the zone. And what that results in is the risk to reward is actually a little bit higher than expected. That also helped to bump this up a little bit. But once you've got a set of trades, you can go through and you can filter based upon parameters and see whether or not those parameters would have helped or hurt. Like for here, if I had this ratio as a requirement, have this ratio be larger than 1 in order to enter the trade, I would have had 4 winning trades and 6 losing trades. And you can do the same thing for the other parameters here. So the thing to watch out for is you need to have it so that you have a large enough sample size after the filter in order to actually implement the filter. And in my own trading, these would actually be like the moving averages or Bollinger Band stuff or that type of stuff. But I just made up these in order to have them as an example. So that's my process. And here's the revisions I did, or Russ did to his trade plan. So both times it must be a liquid or trustworthy stock. But he's switching from just looking at the dollar volume of the stock to go over to the world of optionable stocks. Now, a lot of these options will have a huge spread, but they'll still be available to, if you go deep in the money, possibly to have a little bit better price and in order to get some leverage. The reason for the switching over the options is a lot of the trades look like they'd be good credit spread possibilities, and also in order to get some leverage, uh, in order to bump up the risk to an amount that doesn't result in having a single position that's as large as your buying power. So open interest is pretty standard screen for options. 500,000 shares. Since it's swing trading, you can go a little bit lighter than a million. Close price greater than 20 because options act kind of funny if you get too low in the stock price. So I just want to keep it above 20 for 2 reasons. Get options. I mean, if it's a 50-cent option and you're like a $5 stock or something, there's a huge percentage of the price of the stock. But once you get up to a decent price, they do a lot better. And then the same, no frequent gaps, no leverage, no widely swinging stocks, that type of stuff. A pretty standard uptrend rule, looking at the slope and previous day close above an MA, and then whatever Russ's trade plan depends upon having indicators line up properly with the area of interest. So I just have that as a line there. And then he uses the entire area of interest still. All the rest of the stuff stays the same except for the option portion. But one other thing is he's taking class and the instructors having a lot of neat suggestions, that type of stuff. Sticking to this trade plan is great, but in order to learn better, um, he's going to be using trades based upon the teacher's advice and suggestions and documenting what choices he took as far as which entry choice and why. Uh, there are some additional parameters here which go way beyond just the indicators and the area of interest which is being covered, and he wants to be able to learn that, so he's including that additional trade plan into his procedure, so he now has two ways of getting the trades. And that concludes this overview of the way that a trader called Russ does his documentation. Thank you for your time, and I hope you the time you spent here has you've learned something and it's been useful. And thank you for listening until then. So until next time, goodbye.